So here's the problem in front of us. I'm going to be flipping back and forth between this and the pension worksheet, and I'm sorry for all the background noise. I'm outside and there's birds and stuff, so hopefully it's not too distracting to you. But anyway, so here's the problem, and I've created a pension worksheet for us right here. And whenever we're looking at a pension worksheet, we bring over the balances from the prior year. So the balances of the projected benefit obligation, that is, the plan assets, and then whether the company has a pension asset or a liability. So we go back to the problem here. We'll start off by pulling a couple of pieces of information, and let's start right here. The plan assets have a fair value of $900 million at December 31st of 2016. So we have $900 million that are, it's not the projected benefit obligation, but the plan assets. And we need to know what the projected benefit obligation is at that same period in time, the end of the year. So the projected benefit obligation, you got to read all the way down to here. They tell us that before this company had a plan amendment, there was a projected benefit obligation of $875. Okay, so we had $875 million. And the only logical explanation to determine whether we have an asset or a liability is you look at the difference between the two. We have more assets than we have of an obligation, which means we have a pension asset on our books of $25 million. Okay, so that's how we start the problem. So next we're going to look at this part that says that the company had a plan amendment, and that plan amendment had an effect on prior years that the employees have worked for us. So that's $75 million. And the FASB rules say that it's really a cost to us, the $75 million, but we're not going to recognize that increased cost in the current accounting period only, because that would cause a huge fluctuation in net income. Net income would go way down for the current year because of this plan amendment. So instead, we're going to smooth that effect out by moving it over to the other comprehensive income section of the balance sheet. And so I'm also going to denote whether these have a debit or a credit, because it'll help us at the end. And this is like a loss, it's an expense, so it would have a debit effect to the other comprehensive income. And what happens with that change in the plan is that we now owe an additional $75 million to our employees, and that's going to be a credit because a liability is a credit, an obligation is a credit. So I guess I should be consistent and start here with a credit, and the plan assets would have a debit balance. And let me just move that out a little bit. I don't know, I guess you can't see that there. And then the pension asset would also have a debit balance. Okay, so and it's important you put this in the right spot. So because this change in the plan is kind of retroactive, so going back to prior years means that my beginning PBO is actually not $875, it's more than that. So on the first of the year, and that's this row here that I have the cell highlighted in, we really have a $950 million credit balance in the PBO. My plan assets are still the $900 million, and that's a debit balance, and my prior service cost is $75 million. So now we're just going to keep going through the problem and identifying the elements of pension expense and pushing them into our pension worksheet. Okay, so this part's not too hard. We know this prior service cost will be amortized or expensed over 15 years using the straight line method. So we take 75 divided by 15, and why don't I deal with that right now? 75 divided by 15, that's the amortization of the prior service cost. So that's $5 million, and pension expense is an expense account, so it would actually increase pension expense for the current year. And what that does is it takes away from this accumulated other comprehensive income. So we're saying, yep, we're going to slowly recognize this loss over 15 years to smooth out the income net income effect. So we debit pension expense, and then we would credit prior service costs, the accumulated other comprehensive income. Okay, so now let's go back to the problem and see what is next. we have a service cost of $31 million for the current year. So that service cost increases pension expense in the current year, and it also increases my PBOs, my projected benefit obligation. Those employees worked for me for one more year, and now I have an obligation as a result of that. The next item here, the actuary, the discount rate, and the expected rate of return were 8%. Now, this is very confusing. I think the book does a terrible job in explaining how this works. And we have an actual rate of return of 10%. Okay, hold on. So let's go back here. Actual rate of return, that means the $900 million, we actually received a $10 million increase in the value of the plan. So we add $90 million, 10% of $900 million, and the value of the plan increased by that much. So the plan assets logically increase. Pension expense is reduced as a result of that $90 million. So we can go ahead, and you would think you would decrease pension expense for $90 million. However, and this is where the book does a bad job, we use the expected rate of return to calculate the effect on pension expense. Again, the reason for that is because of the wild swings in the market that can happen, like with the burst of the economy in the late 90s and the mid-2000s here when the stock market crashed. We don't want to have a huge effect on the net income. So we take the actual rate of return, not the actual, but the expected. And if you go back to the problem, it says it's 8%. 8% of the $900 million would be a $72 million expected rate of return. And that actually decreases the pension expense. We have a credit effect to the pension expense. What you'll notice is debits don't equal credits along this line. We're off by, looks like $18 million. So that $18 million needs to be accounted for. And what the FASB's rules say is you use the corridor approach to determine whether any of that $18 million, that's a difference of $18 million, right? So that's actually a loss of $18 million. We thought we were going to have a $90 million gain, but we thought we were going to have a $72 million gain. We actually had a $90 million gain, so we are off by $18 million. So there's a 2% difference that we're off, and so that $18 million gets debited to this account. I think it's a debit. Hold on, let me think about that for a second. So it's debited to this account. It's actually credited to this account. Sorry. So that's credited. Alright, so now this entry has been taken care of, the actual return. So now let's go back to our problem. And the interest expense, so the expense account, you're going to take the discount rate, which is right here, the 8%, times the beginning PBO. Beginning PBO is not 875, it's really 950. So you take 950 times 8%, and 950 times 8% is $76 million. And that's going to increase pension expense. It's also going to increase the projected benefit obligation. Alright, working our way through. So that's it for those items. We're told the company contributes $16 million to the pension. They write a check to the third party. And so that's the contributions. They're contributing to the plan. So they have a $16 million credit to their cash account. And that's going to actually increase the plan assets by $16 million. Debits equal credits. It has no bearing on pension expense. And lastly here, we had some retirees that are collecting from our pension, and they drew down on the pension $22 million. So that actually has no effect on the pension expense in the current year, because we've already expensed the pension costs when the employees actually work for us. That's the matching principle. And now they're going to receive the payments when they're retired, and most people would want to credit cash because it comes out of cash, and that would be logical, but it doesn't come out of our cash. It comes out of the pension plan. So we have a $22 million decrease credit to the pension plan assets. And we actually decrease our projected benefit obligation because we've paid now some of those prior obligations. So you debit the pension projected benefit obligation. Okay, I know this is a long problem. We're almost there. So that's the remaining items here. There's one last thing, the net loss. So at the beginning of the year, we had in accumulated other comprehensive income $13 million. So at the beginning of the year, January 1st, 2007, we had a $13 million loss, which is a debit balance, to the accumulated other comprehensive income, which is these two columns. I guess this column here if it's related to the gain or the loss. Alright, so now that that's happened, we can take and total our pension worksheet. I'll just label that total. So you would take 31 million, you'd add up all the debits, you'd subtract the credits, and you should come up with a $40 million debit to pension expense. You're going to credit cash for $16 million. The net effect here is not just $5 million. We increased at the, because of a prior year issue with the plan amendment, the $70 million increased other comprehensive income, and then it was pulled out, $5 million of it, so the net effect was a $70 million, sorry, there's a dump truck driving by now, $70 million debit. Very distracting. And then an $18 million credit to the gain or loss. Alright, so now remember what happens here in this pension asset liability. It kind of becomes a plug. So debits have to equal credits along this whole line here. So you take $40 million debit minus this $16 million credit plus a $70 million debit minus this $18 million credit, and you'll find that you have a $76 million deficiency. So that becomes our entry here, and your debits are much larger than your credits. So you have a credit to pension asset or liability. You're going to go ahead and add up, starting with the beginning of the year, projected benefit obligation, all the items, this credit would be a subtraction, the other ones would be an addition, and you would have $1 billion, I guess, $1,035 million debit balance, credit balance. So you actually subtract the debits. I said that wrong when I explained that before. You add the credits, subtract the debits, you have $1,035 million balance. And you take the plan assets starting at the $900 million, you increase it for this, you increase it for this, and you subtract the $22 million to get $984 million debit balance. Okay, so now what should happen here is we see the difference. If you were to subtract these two, you can see we have a PBO. Our obligation is bigger than our assets, so we owe more in the future than we currently have on hand. So we're off, we're short, we have a liability, we don't have enough stored away. So we have a liability, and the difference between these two, if you did the math, is $51 million. And it just so happens that the beginning pension asset liability account had a $25 million debit balance. We subtracted $76 million, and lo and behold, that leaves us $51 million credit balance. And that's accurate because we have a liability of $51 million that should show up on our books because we don't have enough stored away in the plan assets to cover all of our obligations. So I've pretty much explained the problem here. Let me just quickly jot out the journal entry for you. So the pension expense, we're simply going to bring these amounts down. It's $40 million. We are going to then debit, I'll take the debit, so I'll skip the cash, prior service costs of $70 million. Everything else is a credit. Cash, $16 million. The gain or loss to OCI, $18 million. Sorry, that was a truck driving by with a golf cart on the back. Very busy road here. And then we're going to credit, lastly, the pension liability for the difference, and that was $76 million. So our debits equal our credits for the entry. Our pension worksheet actually ties out. I guess the only thing I didn't do was bring down all the totals. So the balance at the end of the year in the other comprehensive income account relative to the prior service cost is $70 million, and it's a debit balance. and in this gain or loss account, you started the year with 13, you added another 18, so actually you're at you started the year at 18, but the debits and the credits are non-matching here, so you actually net the two out, so you'd have a $5 million credit balance. This is where you did that corridor approach to see if this account, the gain or loss, is greater than the 10% of the PBO, or and we'll go through that later. And then you bring down, so these are your balances. Here's the balance in the pension liability account. These would then roll over to the next year's pension worksheet. So I'm pretty sure we answered everything on that question. Yes, it looks like we did. I'm sorry it took so long.